A question we get sometimes from our investors is what will happen if the market crashes when you're in the middle of the deal? Well, John and I are going to be breaking down how we position our portfolio and how we position each asset that we take down to be very resilient no matter what happens, whether it's interest rate hikes or rent growth slows down, or maybe there's just a very negative, we'll say, headline that comes out. We're going to be breaking it all down today. John, it's great to be here with you.
Great to be here, Mark. It's an understandable question, right? We always have market downturns, right? And sometimes they're unpredictable. It's like you sometimes a recession every 5 to 7 years, right? But I think what's happened is after the global, Great Recession in 2008, and then the pandemic, the rules have kind of changed a little bit, and so arguably right now we're starting to see a bit of a slowdown in the economy. And I think why I'm really looking forward to this conversation is that in our opinion, right, with the right strategy and the right structure, you can weather these storms, right? Because it goes back to why we like multifamily in the first place. It's a core human need, it's housing. And so it really is all about having the right strategy. And Mark, I think a lot about, our start in this business, right? When we first got started, we were actually coming off of one of the highest peaks in multifamily in history, right, where the market was a bit overheated. And so arguably over the last couple of years, we've been in a bit of a downturn for
Mm,
commercial real estate,
yeah.
right? And I think the benefit for us is we've been able to look and see the mistakes that maybe other operators had made, and to be fair, using the best information they had at that time. And that's really helped inform our strategy going forward. So really excited to dive into this topic today.
Yeah, and it's the natural question that investors have. They it's natural to be able to say, okay, what's the downside when the downside actually happens? And so that's where I think in any sort of real estate deal, you got to go back in history as to, what happened when market crashes. And so when I think about that, John, I think about the 2008 real estate crash, right?
Yeah.
Where there was these subprime loans and real estate just took a real nosedive. I mean, there was way too much supply. There was way too much free money that came out. And at the end of the day, real estate was, we'll just say, it was very inflated. And it was interesting because when I first got into the creating the company, John, as you know, this was one of the things we talked about. And going back to 2008, we looked at what happened in multifamily. So what I did was I went to Florida market and I looked at 50 units and above. And I'm like, what happened in that market to the multifamily space? Because I knew on the single family, it took a nosedive. Well, what was interesting was that pricing dropped by 40% from the peak to the lull. There was a 40% drop in property values. But what was really interesting to me is that rents only dropped by 6%, by 6%. And so this was like very, we'll say, reassuring for me that even at a massive drop like that, rents only dropped by 6%. It meant that if you structure the portfolio in a way, we could have weathered the storm if we introduced these golden rules that we talked about, John, and that we've implemented in our business. We would have weathered the storm of 2008. And so that's like very reassuring when you're structuring and you're taking these assets down and you have tens of millions of dollars of investors capital along with your own personal capital, John.
Yeah,
It's
that's right.
like it's good to know that, and the worst time, something like that, with 6% drop in rental rates, that we could have structured it in a way that would have protected us through that time. And we're going to be diving into what those are in today's talk.
Yeah, that's right. And if you're kind of intrigued by what we're talking about here, if maybe you've listened to a few other episodes, go to fulloutinvesting.com. It's a great resource we've created that makes it easy for interested investors to learn more, not only about what we do, but how these deals work in general, right? So we have a sample deal on there as well as a video that outlines our 10-step process from finding the deal all the way to exit, as well as an opportunity to connect with us if you'd like to talk further about your investment goals. So fulloutinvesting.com. But yeah, Mark, I mean, gosh, what happens in a crash, right? Occupancy could potentially drop because of maybe job loss or maybe potentially migration, right? Sometimes you have, we've used on past episodes Detroit as an example, where that
Yeah.
market is so dependent on auto that when auto has a recession, there's just massive job loss, and then there's out migration, right? So, we're going to dive into these in more detail, but looking for states that are gaining in population and growing with new businesses moving to the area, right? But rent growth could potentially stall even, not necessarily a major occupancy issue, but maybe just our rent growth stalls a little bit. And that's where we'll talk a little bit about our forced appreciation model. And then interest rate spiking, you've already mentioned. So, these are things that could happen even with the best of intentions and the best research and choosing the right market. But you nailed it, right? And it's interesting. You looked at Florida and saw that 6% dip in rents. But if you actually looked at the entire United States, it almost flattened out where it just was flat for a couple of years. So there were markets that even, saw, positive rent growth potentially in that period, because it always comes down to things like supply and demand, right? Which is what we're looking at when we select markets. So, at the end of the day, we built these in such a way where, I don't want to say worst case scenario, but that idea that if we found ourselves at the end of that 5-year hold and the market conditions weren't right, we can optionally extend for a couple more years. Our agreements do allow for an additional 2 if we think we need it to get that end result that our investors are looking for. But it goes back to built the way we do it. And we're going to go through the 5 things we do to protect the downside. You're going to see where, we will never be able to eliminate risk, but we've been able to effectively reduce and in some cases mitigate that risk.
Yeah, for sure. And just before we dive into the ways that we really protect the downside, is first off, let's just talk about the asset class itself. So when you're buying 100 units compared to, say, a single house. So just so everybody's aware, and I think if you've listened to the show, you would know that I've cut my teeth on single family real estate investing. So right from pretty much 2009 right up till the peak of the market, we accumulated many, many, many single family homes north of Toronto. And we were just buying them, year after year, multiple properties, multiple properties, multiple properties. We built up a portfolio in an appreciating market like it was, and it was actually cash flowing at that time. It was a really great model. But one of the things that I knew is that if there was a resident that made a mess, it actually made the property go to zero for income very quickly.
Yeah, that's
Like
right.
it was just zero. And there's just one time that I went against my rule, and I had another realtor call me and said, I vouched for this tenant, but I'm like, she has a bankruptcy on. He's like, I vouch for her. She's my assistant,
Oh,
and
yeah.
I went against my rule the one time, John, and I learned pretty quick that with single family, if you have a bad tenant, not only can they destroy your entire investment, 100% of it very quickly, but if they stop paying, you can go down to zero very quickly in income. And just imagine, John, buying a business or being in a business, and all of a sudden a couple months go by and you make zero income,
Yeah.
zero income. And so that's like a perfect example, I think, or a definition of a crash. You go to zero for income.
Right. Yes.
Right. And
Yeah.
so this is where right off the bat, I mean, there's a reason why they call multifamily the crown jewel of real estate, is because, generally you have somebody that starts in that single family space and they realize there's more risk there, and they start to get up into more units. Because if you have one or two bad residents or bad tenants that are stop paying, or maybe they cause damage to the apartment, you isolate what the issue is and into a smaller segment of the overall investment. And so right off the bat, you hedge your bet in a big way by buying more units. The more units there is, there's more risk, there's less risk with the more units, right? And so I think starting off with that, regardless whatever market you're in, you can go to zero if you have one unit, whereas with multiple units, you get more opportunities to be able to get it right, so to speak, with the more units that you get, which I think is like a really good first step to be able to protect the downside with any sort of massive market crash, so to speak.
No, 100%. It's such a great point, because typically on the deals we're doing now, in year one, it might be a little bit higher, but we have a break even occupancy that we look at, right? Throughout the whole life of our ownership. And so we're calculating our debt payments, our insurance, our taxes, all those, hard costs, and then obviously just the general expenses. And we're projecting out our NOI. And so more often than not with the deals that we're doing here, our break even occupancy is around 70%, in some cases lower. Now, in year one, it might be slightly higher, but it's that idea that literally 20% of the residents can move out and we're still cash flowing. Now, we wouldn't be happy, but at least we're not, upside down or underwater. And so I think that just illustrates that even more clearly. One, you have a bad tenant, boom, you're toast. You have 100, you could potentially have 20 people move out and still, be cash flowing, right? Once again, albeit you might not be happy, but it's still cash flowing. And I think that is such a huge component here. And it also just speaks to, once again, that crown jewel of real estate, right? It just allows for so much because look at like retail, look at office, there's so many boom and bust cycles in that world. And we're seeing it even today, even with back to office, people are wanting different kinds of offices. So dated office buildings are, kind of sitting stagnant, right? And so, the value of what we do here is truly, and we're going to get to this, but that forced appreciation through renovations where we can continue to drive up NOI while not really spending a whole lot of money. But I think the first thing is really, and this is, how I think about it, like debt should never be the reason a good deal goes bad, right? And if you look at what happened in 2018 to 2021, 2022, rates were so low that a lot of operators were often choosing to take floating rate debt, even though fixed rate financing would still be a very attractive rate. It's interesting because in 2020 hindsight, right, people are looking back and wondering why they made that decision. But, the lenders were pushing it. There was, lower rates, right? And we had been through this cycle where rates had been low for a long period of time. And of course, the pandemic changed everything with the hyperinflation we experienced. So, if you're new to this podcast, our number one golden rule at Faris Capital Partners is we only do fixed rate financing. So if the deal doesn't support fixed rate financing, it's just not a deal we're going to do. And I think that really is so strong because we have long-term fixed debt. We can really accurately project out. We can't always control the market dynamics. We can't always control what's happening with occupancy in an area. But when we know what our debt payments are, we can plan accordingly, right? We don't want it to be some guessing game. What's our rate going to be in the next 6 months, right? If rates go up or down or whatever. So it's the largest expense and it keeps it predictable, even if the market isn't. So having fixed rate debt is so critical in my mind.
So for context, the adjustable rate mortgages, so that can go up or down during a hold period. And so with that, you just don't know if the rates start going up, all of a sudden your mortgage payment, so you're going to be paying, in some cases, it's interest only for generally the first couple of years, interest only that you're going to be paying. And then it gets into you're paying principal and interest. Well, if the interest rate, say, doubles, all of a sudden your mortgage payment that you're going to be paying can actually, almost double as well. And if it almost doubles, all of a sudden, if that property was cash flowing, as in it was making more income than all of your expenses, it's no longer doing that. And so the biggest problem with that and why a lot of operators are struggling in today's market, as you mentioned there, was that the rates, like, they doubled. And all of a sudden the operators that had that floating rate, they're all of a sudden they were caught. And so the issue there is that when it doubles, that you then have to start coming up with ways to be able to pay your mortgage and all of your expenses. You have to come out of pocket. So why this is so important is because when you're buying a property of tens of millions of dollars, this is not just something you can dip in your pocket and you start feeding the deal. Like most of the single family rentals that are out there today, right? Rates went up and then you can just float it and it's fine for a short period. But the last thing that you need on a $20 million building is for it to not be carrying itself, and you got to come out of pocket, or you got to take some oxygen from somewhere else and put it into the deal. And that is a perfect definition of a liability, as something that's taking money out of your pocket and rather than something that's putting money in your pocket. And so these assets turn into liabilities very quickly if you don't get fixed rate debt. And this is one of the biggest reasons why we do it. We make sure that the deals pencil out with 5-year debt, because if rates go up, we don't want to be left holding the bag.
That's right. Yeah. And Mark, candidly, I mean, some cases the rates tripled, right? I mean, and so you can see if your rate triples, what does that do to your payment? And so it's really created, circumstances and situations where if you look at the fundamentals of the deal, outside of their debt payment, it's still strong. Like the rent's growing, like, things are going
Yeah,
well,
exactly.
except their debt
Yeah.
payment is now triple, right?
Yeah.
And so in and of itself, the debt killed a good deal, right? And so that's
So
why
good.
we only do fixed rate financing. Number two is actually also our second golden rule, which is we always build significant reserves. Mark, one thing you always say that just sticks with me is cash is oxygen in a business. And what we're doing here is we're buying a business. We're buying an apartment complex, but effectively we're buying a business. And so the goal in buying a business is where you can reduce and control expenses. It's harder to reduce expenses today, but you can control them. But you can't always predict what could come. So cash in the bank is like, control in stormy weather, right? And so by having, generally speaking, we target 6 months of principal and interest in reserves. Now that we do occasionally have some exception to that, and that's where the deal's already cash flowing very strong and it just doesn't need that kind of reserve. But generally speaking, we start with 6 months of principal and interest, and the majority of our deals have that in place. And then we do a 10% contingency buffer on all of our renovation expenses, our CapEx dollars. So whatever we think that budget's going to be, we net it up 10% and put that in the bank for a rainy day. And that just gives us runway at the end of the day. So if we do have a dip or some challenge or issue, we're not having to go back to our investors and do a capital call. We can leverage those reserves for what they are intended for to help us navigate that rainy day and get us into clearer skies.
Yeah, 100%. And the good news here, John, I mean, all the assets that we've taken down is we've been on budget with all of our assets as well. So that 10% contingency is just, we'll call it a little extra peace of mind, a little bit of insurance there sitting in there just for a rainy day fund if needed, if
Yeah.
needed, right? But hitting the budget is like really important. And, the good news with us as well is because we're not doing any major renovations, like we're doing kitchens, bathrooms, and it's just rinse and repeat, right? Rinse and repeat with these renos that we're doing. It allows us to stay, on budget very consistently, and but having those reserves in there is just extra oxygen, just in case if something were to ever come up, which is again helps us sleep a little better.
That's right. When we mentioned, kind of occupancy challenges, but stuff happens, right? Like on our Largo deal, the irrigation system stopped working, and it was actually an issue with the well. We had to dig a new well. So by having that extra budget in there, in fact, what ended up happening there is we had actually overestimated some of our renovation expenses. So we had a little bit of leftover. So we didn't even really have to dip into that contingency, but stuff happens, right? Unexpected expenses come up. So just having that there, just it's peace of mind. To your point, it keeps us warm at night when we're sleeping. So, yeah,
100%. And so this next one, John, is so near and dear to my heart, is
yeah,
finding cash flowing properties. So we only buy cash flowing properties. So just for the listeners out there, cash flowing properties means that there's more income coming in from the rents. We'll call it the rents and any other income that you're generating. There's more coming in than all the expenses, such as insurance and including your mortgage as well. So insurance, operational expenses, property management, all the rest of it. There's money left over that's going in your pocket after you pay everything out. And so by doing this, this is extra cushion or extra reserve just in case. So it's one thing to be breaking even and then having a reserve, but cash flow actually it gives you an extra reserve, so to speak, as well. And so one thing is like with cash flow is that that's the kind of stuff that you can go and do extra things with. So this is a definition of an asset is something that puts money in your pocket. Like for this latest deal, John, that we just took down in Atlanta, this property in year one spits out an extra 500 grand a year in excess cash flow. Like this is beautiful. This is after paying out everything. You have an extra 500 grand that we give back to our investors in the form of cash flow. And because we structure it as return of capital as well, at the end of the year, they don't have any sort of tax consequence that they're paying. It's only until we sell the asset do we structure it then as a capital gain is where they have their uh, uh, we'll say tax payment that needs to be paid. That's like after 3 to 5 years. So they're basically they're pushing they're kicking the can down the road when it comes to taxes, and they're actually getting a monthly drip in their account each and every month. And I was just on with an investor, like he's been in multiple deals now, And he's like, I'm loving the cash flow dripping in every single month. Like, I'm just loving it. And he's like, I love getting my little update there too. So it's like every month on the 30th of the month, you're seeing an update with, hey, listen, here's the cash flow that actually they see in their bank account. But in the update, it's like, here are all the renewals. Here are all the new leases that we signed. Here's what we were charging, and here's what we are charging now, and here's the delta, and here's what that adds to our net operating income and the overall projected value. And people can see is like, listen, we got a $300, 400, 600, 800. Like, John, we had $1,000 rent lift in one of our units, $1,000 a month.
Yeah.
And so, with for every 100, it adds $24,000 in value. That's 240 grand. That's $250,000 rent increase in value of the building based on the income approach. And you can go back and check out how we came up with that number with the income approach, net operating income over cap rate. There's a whole other talk on that as well. But with that cash flow, I mean, there's one thing after another why that's so important, but resiliency in the deal is at the heart of why that's really important.
No, it is so critical. And it just goes back to, if you had an option to purchase a company that, maybe had some inefficiencies, but was profitable versus one that, had inefficiencies, but was not profitable, and all other things being equal, which would you choose? You choose the business that's already profitable today, right? And so that's exactly how we're thinking about it. It helps reduce the risk because the deal's already working. We're just going to come in and improve it. Now, it's not to say that, maybe the current operator is mismanaging it to a certain extent or underutilizing, aspects of the building or the amenities, or in some cases, right? Sometimes you just, and we see it when we tour rent comps all the time. Sometimes they're just not their weak property manager. Maybe they hired the wrong vendor. And so, we've talked about this on previous podcasts, but when we see bad reviews, we actually like that because we know we can fix that pretty easily with the way we train our property managers. But it's all about, just to me, it's just fundamentals of business, right? Profitability is good, right? Cash flow is good. Cash is oxygen. So, further to that, point number 4 is we always underwrite very conservatively. So, we're touring these rent comps. So we're using real rent growth projections based on today's comps. We're not like living in wishful thinking or fantasy land. Like, we're saying, like, what is actually happening in the area? We can look back, 10 years of history. What's this market done? And then we can leverage forward-looking data that, we have to be a little cautious with, but that's where we become conservative. So if the organic rent growth, which for the person listening, if you're new to this and you don't know that term, organic rent growth is just, if we don't do any renovations, what can we expect to see in terms of the rent growth for that particular unit? And so maybe say, for example, the report showing 3.5% annual rent growth. We're going to underwrite at 3. Just pull it back just a little bit. Now, generally speaking, we've talked about, that $1,000 that we were able to increase just that one unit with our renovation. But on average, at most of our assets, we're actually hitting 5 and 4.5, 5.5% organic rent growth on our renewals. But that's because of the way that we institute our culture within the community, right? With our guarantees, making sure all maintenance requests are done quickly, having the leasing center open, those on-site team always available for their current residents. And I think that's an important point. I think naturally you might assume that on-site team is all about signing new leases, but almost more importantly, it's about serving the current residents, right? Making sure that if they have a challenge, we help resolve it. Just, learning their names, saying hello, figuring out what's going on with their kids. And, we do a farmer's market, at some of our assets. We give away backpacks around the start of the school year, just various things like that. It's really almost more important than signing the new leases, right? And so it's such a big part of what we do. Now, going back to underwriting conservatively, similar with cap rates, right? Like, we try to be a little more conservative than what the forward-looking projections say. And because we have great relationships with vendors, for example, where it makes sense, we single source our vendors. So, for example, the team that does the majority of the actual renovations is the same company across all of our assets. So we achieve a little economy of scale because we're giving them so much business. So our renovation costs are really tight. And you nailed it. You said it at the top of the podcast, but we've always come under or at budget. We've never gone over. And that's because we have great vendors that we trust, and we're underwriting conservatively, even when it comes to that CapEx. So these aren't ballpark numbers. In other words, these are very thought out, we touched on this, but I would say we're probably spending 40 to 50 hours just analyzing a deal before we even get to that LOI stage, sending out that letter of intent. So, bottom line, if the model only works if everything goes perfectly, it doesn't work, right? You have to factor in the what ifs, stress test the deal, look at the break even occupancy. What happens if cap rates expanded? What does that end result look like for that investor? So, really stress testing the deal is a critical component alongside underwriting conservatively.
Yeah, 100%. And so the other things, we like to keep our options open as well, because you never know what the future is going to predict. And so we don't like these bridge loans where you're hoping that you're going to do a refi down the road. We don't do that. We don't over leverage as well. Like this recent asset, this 114 units in Atlanta, we're at a 67% loan to value ratio, and we're raising all the capex, all the expenses to be able to take this from closing right through to the end of the business plan and sale 3 to 5 years down the road as well. And so we don't over leverage. And then we also, even though we project 3 to 5 years, we understand, I mean, the market could take a swing in year three
Yeah.
in a negative light. And so we play that out. It's like, well, what happens if it does drop at that point? What are we going to do? And how are we going to structure it in a way to protect ourselves down the road? So, for us, we say 3 to 5 years, if for whatever reason 5 years comes and it's like it's a horrible time, well, at that point we either look at doing a refi and pulling some equity out to get some funds back to the investors, or we basically every single 3 months, every quarter, we're doing an assessment. Is this the right time or not? And by that time, we're going to be cash flowing at a much higher rate as well, because we've driven and forced appreciation by driving increased rents. And this is where the value add play, John, it builds in this resiliency in these deals, because down the road, 3 to 5 years, that allows us to go through, renovate these units, get through this business plan where we're pushing and increasing rents. And that increase will help swallow any sort of downturn that comes in the future. So it builds in extra resiliency. So it's cash flowing from day one, and then we go and we force the appreciation and we force increased rents by doing these renovations. That's why it's so important to find the right deal. And that's where, John, I mean, you're right there on the front lines. It's like 1 in 300 to
Yeah.
find the right one that actually has upside in the deal and it's cash flowing from day one as well. So we like to keep our options open when we're going into these investment vehicles, because we know that things can change.
That's right. Let's look back at history a little bit. '08, you touched on that. There was a bit of pain in '08. Some markets saw negative rent growth, some saw flattening rent growth, but well capitalized operators that held on did fine, right? Like values recovered very quickly, particularly in multifamily. Residential, just to be clear, took a lot longer. I mean, it felt like it was about 4 to 5 years to get back to kind of, at least in my mind, I'm still a little traumatized, I guess, after spending, 4 or 5 years navigating that. Now, it's interesting, although I say that looking back, every market provides opportunity, and we got into working with institutional investors that were acquiring these single family homes. So, actually in hindsight, it was really an interesting, cool time, but, seeing all these sellers in pain, I mean, that was where I really struggled, because I was on the front lines with short sales, helping folks navigate these situations. But 2020 is interesting because there was short-term pain, but then we saw rapid rent growth in key markets. Now, why are some operators in pain? Even because of that, because they didn't take down the right debt. We already touched on the floating rate debt. I had an interesting conversation with Dugan Kelly. He is one of the key principals at Kelly Clark, and they're our securities attorney on the U.S. side of the border. But I asked him about the floating rate thing, and I said, why do you think operators were doing that? And I kind of knew the answer, but it was exactly what I thought. So operators that were taking this floating rate were actually able to fund their renovations by drawing from the loan. And so maybe it meant that they had to raise less capital to do the deal. Well, you just said it. We raise all the capital on the front end, right? So plus the contingencies and the reserves, right? So we have the oxygen in the tank to deploy when needed. And so that's where some of the operators are doing it, because it was a bit easier. You didn't have to raise as much capital, but then rates tripled. So it just goes back to, even if you'd bought in 2020, but you bought with fixed rate debt, you probably crushed it. I mean, your investors were probably so happy, but with the floating rate debt, those are the operators that got in trouble. So it just goes back to these five principles always apply no matter what the market is. And look at today, right? The Sunbelt multifamily market is still outperforming due to all those demand drivers we touched on: population growth, economic growth, more companies moving into these areas. So it's not to say there's a guarantee here. There's not. There's no guarantee in any investment. You know, things could go completely sideways, things outside of our control. But if you follow these five key principles, you've helped effectively reduce the risk and in some cases completely mitigate it.
Yeah, 100%. And that's where, if you set everything up the right way with the right rules, it helps protect you when you get tempted.
Yeah.
And like when you got something that's sitting in front of you that it looks so tempting to do because there's like some sort of shiny apple in the short term. I think, John, it's been really great for us that we got to see other operators like firsthand, like go through some of these challenges and to actually see it. And so this is where for us, it's like, okay, that was part of the thing right off the bat. It's like, here are golden rules that the company is now formed upon, that this is how we're filtering decisions through these golden rules. Now, this is where we've had, this is why we keep talking about it as well. So
Yeah.
down the road, you don't forget these golden rules,
Yeah.
but when
Yeah.
you base a foundation on that, that's very, very, with the right fundamentals over time, it allows you to play the game longer because going through any sort of crash or downturn is just never a very fun thing. But with real estate, the good news is that you can weather most, if not all, storms if you do it properly, if you structure it properly when you're not in the problem. Just like with lenders, lenders will give you lots of money when you don't need it. Is when you do need it, that's when they don't want to give you capital. So make sure you get all your lines of credit and everything when you don't need it. And for us, our take is when we're going in on the deals, we need to stress test the deals and set them up from the very beginning, because once you're in, it's hard to start changing trajectory, and a lot of times you can't.
Yeah.
And so we've gone through all of these different scenarios that could have come up, how we protect it, and by doing that, it just allows us and all of our investors, the ability to put their head on their pillow when those negative news reports, because we all know 90% of it is negative, when they come out and they're talking negativity about real estate overall, our investors can put their head on their pillow and say, you know what, the group that we're investing with they're investing with principle and safety principles and fundamentals that allows me to sleep well at night. And so that's why we really encourage our investors to listen to this podcast, to really understand, like, you're investing in something that it has very, very little downside, very strong upside. And the principles that we factor in when we take these deals down, it does, that further context helps our investors sleep at night a whole lot more.
No, you're right. And I was laughing a little bit when you mentioned, kind of the three golden rules. I mean, there's been one or two. I remember one that was, we've actually touched on this one on the podcast, just where the operator leased down and was trying to renovate everything at once. And there was a lot of upside, but at the end of the day, there was no cash flow on day one, right? Because of the way the lease down had occurred. And so we didn't spend a whole lot of time on it, but we had some conversations because the returns looked good. But then it was like we reminded ourselves, no, the golden rule, right? We always have cash flow on day one. And then there was another one in Tampa I remember looking at that was not quite as extreme, but 17 of the units were stripped down to the studs, and the operator didn't have the funds to kind of complete the renovations. But that same thing, it was just that reminder: slow down. What are our principles? What are our three golden rules? And so, you're dead on when you have those those fundamentals in place. Just the key is to keep them top of mind. And those two examples where we walked away just because it violated one of those rules.
Yeah, right on. Well, hopefully this is valuable for you guys. Now, if you do want to learn more, go to fulloutinvesting.com and find out a little bit more about how we're actually going and taking down these 100-unit multifamily apartment buildings, and how we're working with our partners to be able to do that and to be able to to get these 20% annual returns, doubling money in 5 years. These are what we project. And there's cash flow coming each and every month. Go to fulloutinvesting.com and schedule a one-on-one call with us. We'd love to talk with you and see if this is going to be a good fit or not. If you like the show, you can share with another high net worth investor that you think will benefit from it. Really appreciate you guys. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.